Hi, everyone. Welcome to our meeting tonight with Sean Knudsen, Guaranteed Rate. We're excited to have you here. Tonight, we're going to talk about a very important subject, especially for those of you that have bought a home in the last year or two. It's mortgage insurance, that extra fee that you have on your loan that we all don't like paying, that isn't paying off our principal. And we're going to talk about a way to get rid of it and to remove and to lessen your monthly mortgage payment. First of all, to introduce myself, my name is Jared Fields. I'm the founder of the Fields team with Keller Williams. We are a team of about 25 agents and 10 support staff. We close around 300 transactions per year. We're headquartered out of Orem, Utah, but have agents spread out all throughout the Wasatch Front in Utah. And we love what we do. And not only am I in real estate, but when I bought my first home, which was a townhome in Provo, and then upgraded to a home in Orem, I bought both with 5% down conventional loans. And on both of them, I was able to remove mortgage insurance through some of the methods that we're going to talk about today. And today we have with us special guest Sean Knudsen with Guaranteed Rate. He's the preferred lender for our team. I've known him since I got into the industry almost 12 years ago. So I'll let Sean introduce himself.
Yeah, I am Sean Knudsen. I'm with Guaranteed Rate, and Guaranteed Rate is a bank, a correspondent bank, and we are, across the nation. We're in all 50 states. I'm the branch manager for the local branch here in Sandy, Utah. Been in business for 18, almost 19 years now. Obviously met Jared when he just was starting out in real estate and watched him propel himself into one of the top realtors here in Utah. And as it's just been phenomenal, and I don't say it enough. It's great to see.
And we're thrilled to have Sean with us today. Definitely an expert in the industry. So for those of you that have bought a home, especially in the last 2 to 3 years, and are paying mortgage insurance, legitimately tonight, we are sharing with you ways that may save you thousands of dollars per year in these extra fees that you don't need to be paying. Okay, so take some notes. Again, if you want to discuss the details of your situation, please contact us after this seminar. We're available by phone, email, text, however you can get a hold of us, Facebook, and we can talk about your situation and how we can help you. So first of all, let's get started. Why don't you tell us, Sean, what is PMI or mortgage insurance?
Absolutely. So mortgage insurance is essentially what the lender is using as a way to keep themselves in a good position in case they have to sell this home or sell this loan on the secondary market at a loss. And so they're insuring themselves just like you insure yourselves with a car insurance or with homeowners insurance. They're insuring themselves, but that cost is actually for you, the borrower, to pay. They make you pay it, even though they're insuring themselves with this mortgage insurance. And it's a way to keep themselves, protect themselves so that they don't get hurt if they have to sell it on the secondary market.
Now, does this mortgage insurance, does it go towards principal, or is there any other benefit to the borrower?
Absolutely not. I mean, the mortgage insurance itself is truly just a benefit for the lender. It doesn't help them at all, or the borrower at all. It really is just strictly for the lender to keep themselves from taking any hits on their bottom line in case something happens.
So basically, this is just a pesky fee that borrowers or buyers have to pay that really adds no benefit to themselves.
That's correct. Yeah, it really is no benefit for our buyers, for our borrowers.
So that's often probably why we hear buyers want to put 20% down, or the ideal amount is 20% down. Yeah. Why is that?
Absolutely, because at 20% down, that's when you no longer would be required to have mortgage insurance, at least with a conventional loan. So with a conventional loan, you're not going to be required to have that mortgage insurance once you hit 20% down. But it's also worth noting that, in times like you said for yourself, when buying a home that first or second time, oftentimes for most of us out there, we don't have 20% to put down. And so we expect that is something that we have to live with for, our first or second home that we buy.
So basically, we've kind of talked about this as kind of the lender is taking a risk on these buyers that are putting less down. How does the amount down under 20% affect the amount of mortgage insurance?
Yeah, so the less money that you put down, essentially, the more that you're going to pay in mortgage insurance. As a lender, the lender has certain insurance coverages that they receive based on the amount that they are putting down, or the loan to value. And so the more that the borrower puts down that is still less than 20%, that is going to be a lesser premium that they're going to have to pay in mortgage insurance. So I guess to say it more clearly, the less money you put down, the higher your mortgage insurance is going to be.
Yeah, so I think it was a couple nights ago, we looked up how much mortgage insurance would be on a $400,000 loan with 5% down conventional, right? Which is a pretty standard loan for first-time home buyers. It's 5% down conventional financing. And so it's risk-based. So part of that is the credit score as well, correct, yeah. Right? So on this, if you have a credit score of 740 or more, we looked it up, it would be $85 per month or $1,000 per year.
Yeah.
Right? That's just $1,000 per year on that you're just paying.
Throwing away.
Yeah. But then if your credit score is between 700 and 740, it goes up to 149 a month or almost 1,800 per year. And then at a credit score of about 660 to 700, it goes up to almost 300 per month or 3,600 per year.
Yeah.
That's an amount that you're just paying in addition to your principal and interest to basically to insure the lender.
Yeah, absolutely. And it's unfortunate because you think about that, and most people, I would say on average, this market's a little bit different today, but in most cases, they probably have their mortgage insurance for at least 3 years, 2-3 years at a minimum. And that's you're talking if they're in that 660 credit score range, they're going to spend almost $10,000 on mortgage insurance.
Wow.
That time.
And just think what you as a buyer could do with an extra $300 per month. And right now in Utah, especially in Utah County, Davis, Weber County, Salt Lake County is probably a little higher, but the average purchase price is around $400,000 for a townhouse right now. And so that would be the amount of mortgage insurance that you as a first-time home buyer putting 5% down would be paying monthly. That is, again, just insuring the lender. So why don't you tell us about the different types of mortgage insurance? We're talking about removing your monthly PMI. Absolutely. But let's talk about that there's other types of mortgage insurance.
There's other types of mortgage insurance. So with your standard government loan, which is an FHA loan, USDA, they actually do have an upfront mortgage insurance that you're going to pay. It's a premium that's a one-time premium. In most cases, it gets wrapped into your loan amount. So you're paying it. And not only are you paying it, but you're also paying interest on it. So it's even worse than just paying this insurance that's not, helping you, but you're paying interest on it.
And there's really no way around that if you do those types of loans.
Yeah, if you do an FHA or a USDA loan, there is no way around it. You're going to pay that upfront premium.
And so that's generally why lenders, you recommend conventional financing if buyers qualify with a good credit score.
That's correct. Preferably, we try to keep them conventional. However, if their credit score is a lower percent or a lower credit score, then oftentimes it'll work out better for them to be in one of these government FHA, USDA loans because that mortgage insurance is not as much affected with the credit score on a government loan.
I was going to say, those of you in attendance, if you have questions, please ask at any time. This is something that many buyers aren't aware of. So please ask questions if you have any. So, okay, what other types of mortgage insurance are there?
Absolutely. So going back to the government loan, you have two types of mortgage insurance. You have the upfront premium, but then you also have the monthly, which is really considered an annual premium. FHA, USDA, they kind of do it in a strange way where they average out your principal balance over an entire year. And each year, based on that principal balance, they then take that annual amount and prorate it for the entire year. But that is a monthly mortgage insurance that you're paying within your mortgage payment every month. That is also, a monthly mortgage insurance is also connected to conventional loans. So conventional loans also have this monthly mortgage insurance. So all mortgage insurance, in most cases, I would say the preferred way, or not preferred, but the way that most people do mortgage insurance is with a monthly payment. And whether it's a USDA, an FHA loan that has to have it, or a conventional loan that you have options, most conventional loans have monthly mortgage insurance.
And so just to clarify, basically on an FHA or rural development USDA type of financing, that mortgage insurance is going to be charged automatically, and there's really no way to remove it.
That's correct. Now,
but on conventional financing, there are ways to remove that monthly mortgage insurance.
Correct. Yes. So a conventional loan does have an option for you to get rid of your monthly mortgage insurance. And a lot of people don't know this. And I think that's part of the reason that you wanted to have this conversation today.
Yeah. So for all the buyers out there that are homeowners out there that are wondering if they're paying mortgage insurance and how much, how do they go about discovering what type of loan they have and if they're paying mortgage insurance?
Yeah, it's pretty simple. I mean, you can easily go to your monthly mortgage statement, and within your monthly mortgage statement, or online if you're using your electronic messaging from your bank or whatever it is, you can go on and see your electronic statement or your paper statement and see what type of loan you have and what the mortgage insurance premium is or the mortgage insurance that you're paying monthly. It's usually within your escrow account. So if you were to look for your escrow account or the escrow payment for each month, you'll see that mortgage insurance within that payment.
Awesome. And so if you're one of the past clients of our team, feel free to reach out to us as agents or your loan officer, and they could also help direct you to where to find this information, what type of loan you have, and how much your monthly mortgage insurance is. But now to move on to the exciting part. So let's say you have a conventional loan, you are paying mortgage insurance. Let's talk about the 4 different ways that you can remove mortgage insurance and lower your monthly payment or start paying more to principal. Okay, so Sean, what are the 4 ways? Let's start with the first one, which is refinancing and the pros and cons of that.
Absolutely. Oftentimes people think this is the only option. And so I'm glad you started here because then it allows us to show you the other options. But the refinance is the most common way that people think they have to get rid of their mortgage insurance. And it just involves going to your lender, your preferred lender or whoever you work with, or if you want to work with us at Guaranteed Rate, we'd be happy to take you. But you're just basically going to go in and say, hey, I'd like to refinance my home. I need to see if I can get rid of this mortgage insurance. And depending on that appraised value, if that appraised value is high enough, then we can get rid of it. And it just automatically, when we close the loan, if you're under 80% loan to value, you'll get rid of it. Obviously, with this market and how we're looking at things these days, it's quite often the case that you're going to end up with enough equity that you can get rid of your mortgage.
Yeah, so basically, if you purchased a home with 5 or 10 or 15% down in the last couple of years, you can refinance, and you most likely have at least 20% equity now, and it would just automatically, it would almost be like putting 20% down, and you would no longer have mortgage insurance if you refinance. But what's one of the cons? What are the cons to refinancing versus some of these other methods?
Absolutely. There's definitely the cons that come with it, which is the cost of doing the refi. You're still going to have to pay. The loans are not free, regardless of what you might hear on the radio about a no closing cost
or the billboards.
There is always cost associated with your refi. It's just built into the interest rate. And so what you're going to obviously experience is that there is a cost associated with it, whether it's the lender fees for their overhead, it may be the title fees. If there's an appraisal required, there's appraisal fees. So there's a lot of fees that can come with a refi that you can end up paying.
And correct me if I'm wrong, is it usually about 1.5% to 3% of the loan amount can be the cost associated with refinancing?
Yeah, it could be. It's really, it could be the percentage of it. It's kind of hard to say exactly that because there's fixed fees that are, usually the lender fees are fixed. An appraisal fee is somewhat fixed. The title fees can be kind of more of a percentage, but I would say somewhere in that range of anywhere from maybe, I would say even as low as 1% up. That you're going to have these fees, unfortunately, that you would have to pay. So to get rid of your $3,000 in mortgage insurance or whatever amount, you may have to pay $3,000 to do your refi. So is it the right decision?
So let's talk about now the 3 other ways to drop mortgage insurance without having to take on additional costs or maybe minimal costs.
Yeah.
So the first way is just making your minimum payment. If you have a conventional loan and you make your minimum payment, how will mortgage insurance drop off?
I mean, you've got really an option where if you are making your minimum payment, there's 2 ways that mortgage insurance can fall off within your minimum payment. One of them would be if you're able to pay down that equity position of your home. So if your home was originally a purchase price of $100,000 and you pay it down to 80% of that original purchase price, Well, 78% is the legal amount in which a lender is going to say, hey, we have to get rid of it. We can't even try to keep making you pay it if we wanted to. We have to legally get rid of it because it's 78%.
So if you bought your home at 5% down, you make your minimum payment. What you're saying is once you pay down your principal to 78% of that original appraised value, that the servicer has to automatically drop it off.
Absolutely.
But how long does that often take for a buyer or a borrower if they're making their minimum payment?
I mean, that's going to take 7 to 8, 9 years, depending.
Yeah, long time.
Long time.
So this is not an ideal way to have your mortgage insurance drop off. So we're going to talk about ways to do it a lot faster, especially in this market. Many of you watching us could probably get it to drop off in the next week. So let's get to the exciting parts.
Yeah.
Okay, so let's talk about another way about maybe paying down that amount faster.
Yeah, absolutely. I mean, you have options where you can obviously pay down the balance quicker. You can pay down and still get to that 78% loan to value. If you have additional funds, you can do it in a lump sum. You can do it in, extra payments that not just the minimal payment and still get it down to 78%. But there's actually a more fun way to do it, and I think that's probably
and then we're going to get to the last way, which is the way we really wanted to discuss with everyone tonight, is having it drop off through a system that the lenders or the servicers have built in, which calculates appreciation or values going up as part of that value, so that now you have that equity where a lender will, or servicer, I guess I should say, will drop the mortgage insurance. So why don't you talk to us about that?
Absolutely. So this is kind of the fun one, and this is the one that not a lot of people realize, which is with the amount of equity that we're building in our homes right now, just with the market as hot as it is, your appreciation is reaching a point where I would say the majority of my buyers that I've worked with over the past year are now, almost every one of them that's come back to me to refinance, they've already built in 20% equity. And the only reason we're refinancing them is because their interest rates
get a better rate
low.
So let's put some of this into perspective. Since early 2019, we have around 30% appreciation. So if you bought in January of 2019, it's almost a given that you have at least 20% equity, probably 30% from whatever you put down, in addition to what you put down. But even since January 2020, we have 20% appreciation. So if you bought in early 2020, it's almost guaranteed that you have a minimum amount required to have mortgage insurance drop out. But you also put at least 5% down, most likely, on your conventional loan. Now, this is the kicker. This year in 2021, in just 2 months, we're estimating anywhere from 8 to 12% appreciation already. So in our minds, if you bought in the last 6 to 9 months or so, and you put at least 5% down, there is a very, very good chance you already have 20% loan to value or equity in your home.
That's exactly right. And the beauty of this is, and I'm not trying to build this into something that either of us are going to benefit from. This is just informational. This
benefits only you as the borrower, right? This is an easy way for you to make a few calls or send a few emails and get this mortgage insurance off of your monthly payment, and to either pay more to principal or just have more funds available for yourself. So if you feel like you have if a borrower feels like they have 25% equity now, and again, you could find out that amount by talking to your realtor. We can help you estimate value and see if you have that 20% loan to value. But if they do, what is the process that most loan servicers follow in order to drop off mortgage insurance?
Yeah, and it goes back to, we're not trying to set this up as an opportunity for us to refi. This is strictly just, we want you to know this information, which really comes down to just reaching out to your servicer, take out that statement that we talked about earlier to look at what type of loan you have, how much mortgage insurance you're paying. You can take that out and find the phone number, call up customer service for your servicer and ask them what are the steps by which you can go about getting rid of mortgage insurance. There's a certain expected couple steps that we all, it is the norm, but in most cases.
Yeah. I've done this twice over the last probably 6 or 7 years. They had different servicers, and they both did it slightly differently. One, they did what's called a BPO, or a broker's price opinion. And it cost me $150 to have a real estate broker send my servicer an estimated value based on comparables. And when it showed the loan to value over 20%, it automatically dropped off my next mortgage statement. So it cost me about $150, and I started saving about $150 a month, like right away. The other way was through an appraisal, an actual appraisal. Appraisals can cost anywhere from $400 to $500. But again, the same thing, when it shows that loan to value of over 20%, the mortgage insurance immediately drops off. And again, I think I made up that $400 or $450 that I paid within 2 to 3 months, and then the rest was just gravy. It was just great to have.
Yeah, it comes down to just a couple steps that almost all servicers are going to ask the same thing, whether it's an appraisal or a BPO. They're not just going to take your word for it when you say, hey, I've got 20% equity, let's get rid of it. They want one of those items, one of those valuations to be provided. In some cases, you may have done some renovations to your home, right? You may have done, added a basement or added a room within the basement. These things that you can do to your home, they'll take into consideration when deciding if they should allow you to have your mortgage insurance fall off.
And that's a great point. Let's say that you bought a townhouse with an unfinished basement, and in your first 6 months of owning it, you complete the basement and add a bedroom and a bathroom and a living room. There's a good chance that adds a significant amount of value to your property, to where that in addition to appreciation, you now have more than 20% equity in your property, and your servicer will drop mortgage insurance once you can prove that to them. And again, they do that through a BPO or through an appraisal. So there is a little fee involved. It's usually between $150 to $450 to get a BPO or an appraisal. But once that comes in and shows that equity, you now have this fee that no one likes, that does no good for you. It drops off, and it could be as much as $200, $300, $400 a month. Absolutely. It can pay for itself very quickly.
Yeah, it's something that is a complete benefit to you with very minimal cost. There's no reason that someone wouldn't want to attempt this, or at least see what the steps are to make it happen.
And yeah, and again, every servicer is slightly different in their process for how to remove mortgage insurance. So please feel free to reach out with questions about your specific situation. And especially before you take on this cost of a BPO or appraisal, talk to your realtor, talk to us. We can give you an estimated value for your property right now, where we think the appraisal will come back at, and make sure that you have that 20-25% equity in your home, so that you don't take on this additional cost too early. But yeah, anything else that you'd like to add?
I think that's really it. I know that we kind of missed out on a couple different types of mortgage insurance, but I think that we can leave that for another time. Yeah. If someone wants to, reach out or ask any questions. I don't know if anyone from the...
Yeah, any questions from the audience? Yes.
So what are the options if you have an FHA loan? I just want a clarification on that.
That's a great question, because if it's an FHA loan, this entire conversation about getting rid of mortgage insurance without having to refi is completely out the window. FHA does not allow us to get rid of mortgage insurance without doing a refi. There is one small consideration where they do allow you to get rid of mortgage insurance if your down payment was slightly larger initially, but that's only if you have the loan for 11 years, which in most cases, people don't have a loan for 11 years.
And when I bought my first home in 2007, it was FHA, and back then they had a 5-year minimum for mortgage insurance. So I was actually able to get it off, but about, I don't know, when was it, 2010 or 2011, they changed, FHA changed, and they said mortgage insurance will now be on your loan for the life of the loan. And so when you're going to purchase a home, if you have good credit, there is a reason why lenders highly recommend conventional financing, because there is a way to get mortgage insurance off and significantly reduce your monthly obligation. But again, a lot of this is dependent on credit. If the lower your credit score, the more mortgage insurance is, and FHA is more forgiving of credit scores that are a little bit lower.
That's correct.
So, great question. All right, another one.
Okay, so I'm a rookie here, don't laugh. So say somebody has a second mortgage. The first one was no PMI. How's that usually play into PMI with the second mortgage?
No, it's a great question, and it completely, back prior to the financial crisis, it was very common for people to do what was called an 80-20 loan. They would do a first mortgage for 80% and a second mortgage for 20% so that they could avoid that mortgage insurance, because they understood the fact that that mortgage insurance was paid to nothing, while at least if they had a first and second mortgage, their payments were going to the principal balances on both loans. With that being said, if you have a first and second, it's not really about eliminating mortgage insurance in that sense. It's more a question of maybe the opportunity is there right now for you to actually look at a refi and combining those two loans into one.
And so really, like, often you'll want to talk to the professionals, either a realtor, the loan officer, look at your options. Because if you have an interest rate of 4.25%, it might make more sense to refi anyways, right? Instead of having mortgage insurance just drop off through the methods we've talked about today.
Yeah.
You can get a lower interest rate and get mortgage insurance to drop off. But as interest rates have been at all-time lows and over the past 2 weeks have started to go up, refinancing will very likely not be the best option in the future. Okay, it will be using this method to show appreciation and getting mortgage insurance to drop off by paying either $150 for BPO or $450 for an appraisal.
That's correct. And then one of the things I would say also to keep in mind, if perhaps someone was already paying down their balance, and let's say they were at 80% loan to value, and they were almost to that 78, or maybe they're 79% loan to value. If you're thinking in your mind, maybe I should go get an appraisal and get rid of mortgage insurance now, keep in mind that mortgage insurance that you're going to pay over maybe the next 6 months might not add up to the cost of what you would pay for an appraisal. So, you've got to look at those different options to see what makes the most sense for you and what's the most cost effective.
That's a great point. So any other questions? Okay, if not, again, every situation out there is unique and a little bit different. So please, to discuss your specific situation, just reach out to us. It's jared@thefieldsteam.com.
Sean Knudsen. Oh, my email?
Yeah.
Sean@rate.com.
Yeah, and you can message us on social media, text or call us, whatever's most convenient for you. We'll get you in contact with the right people, and we can help walk you through your unique situation. But again, I've done this twice. Both times was just, I had to go through this myself, call my servicer, didn't know exactly what to do, and then I was amazed at how simple it was, and all of a sudden I was saving a bunch of money every month. And I wish I would have done it. I could have done it years sooner on each of them. So please, if you're in the situation where you're wondering about it, don't hesitate to reach out. We can help walk you through it. Again, we don't make anything off of this. This is really just to help our past clients, to put this out there. Of course, your servicers don't want you to do this. They love collecting this extra fee, but this is for you we'd rather you have that money or to pay your principal down more money in your pocket. That's always our goal. So please don't hesitate to reach out. Thank you for joining us tonight, and look forward to doing another one of these soon with more helpful information. But have a good night.
Thanks so much.
Good.